Hey everyone, I wanted to welcome you guys back to the third orientation video for the Value U Academy. For those of you who are just joining us, we'll do a quick reintroduction around the room. And what this video series is like I said, just an orientation before the curriculum starts for the Value U Academy, which we'll be releasing throughout the rest of the year and so on. So Chuck, why don't we start with you with an introduction?
Yeah, thanks, Colt. Yeah, I'm Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. And I'm very passionate about talking about value investing and teaching people how to be better, more prudent, and better informed investors.
And Bill?
Yes, I'm William Kay, and I do a lot of financial training at universities and colleges and with major corporations, and been doing it for many years.
And Nathan?
I'm Nathan Mock. I'm an associate professor of finance at the University of Missouri, Kansas City, and I teach and research on valuation.
Awesome. Thanks, guys. So jumping right into the questions. First one I have for you guys today is, how do you simplify the research process? What questions do you ask? What do you look at? What are the big things you look at and ask? Bill, why don't we start with you?
Thanks, Colton. I first of all think about goals and objectives, as you said. Do I want to invest in strong, ongoing companies? I might want to look at their credit rating. I think about what's happening in the world. Where's the world going? Will these companies be around in the future? So I might want to look at their credit rating from the past, look at their sales. You might want to do a trend analysis over a number of years, their profits, and most importantly, their cash flow. So there's a lot of different things you can look at depending on what you want from your investments.
Awesome. Chuck, what about you?
Well, I think like any job, it's always easier to do a job if you have the right tools to do that job, which is precisely why I developed FastGraphs, the fundamentals analyzer software tool. It allowed me to research stocks easier, quicker, more efficiently. I was able to organize. I used the tool to organize, years of financial information, and then be able to, create trend analysis where I could see, what was the company's growth doing, how successful was its business, how cyclical it was, how consistent it was. If it was a dividend payer, what was its past dividend record. So having the right tools is a great way to simplify the process, in my view.
And Nathan?
Yeah, I think it makes sense to really focus in on big questions and the big fundamental issues that matter to you about the investments that you're considering. And once you've got a clear identification of those big questions, then the answer is really, how do you answer those questions? And I think that's really what we're going to do with the Value U Academy, is really cover the process to answer those questions. And as Chuck already mentioned, having the process is one thing, having the right tool, having the right data, the right information is really the key. So bringing all that together, having a clear idea of the questions, having a clear idea of the process to answer those questions, and then having the data to do it. I think that's the simplest way to approach the investment process.
So information seems to be key, and correct information and right information seems to be key. And so there's a lot of information out there in the investing process and what people can look at, different metrics, different ratios. And there's some debate about some of those metrics and items that you can look at. I think beta is a hot topic kind of one, especially for this group. So Chuck, what do you think about beta?
Beta is probably the number one metric that we get asked for to be adding to FastGraphs. I'm not a big fan of beta because one of the things that I preach all the time is it's much more important to focus on the fundamentals first and foremost, stock price second, and beta is more of a stock price oriented metric. It's trying to measure how volatile a stock has been. The problem is first of all, beta changes. A lot of people use a 5-year average beta, but the high beta this year could be a low beta next year. So it's theoretically a measurement of volatility, which is, in the academic world, theoretically a measurement of risk. But, I see risk much more practical. What's the risk of the business being an ongoing concern, for example? So I'm not a real fan of beta. I also, when I developed FastGraphs, I created, the ability to look over a company's long-term history. And I do it in chunks, 1 year, 5 year, 10 year, 15, up to 20 years. And I can see how volatile a stock has traded. I consider that to be much more valuable. A piece of information is not always wisdom. It's organizing information in such a way that you actually are bringing wisdom to the equation. I just don't think beta has any practical application. Warren Buffett talked about about that quite a bit. He talked about the fact that, when he bought the Washington Post, at $80 million, he was buying $400 million worth of assets. His argument was that if the value would have fallen to 40 million, then theoretically, that was riskier than buying it at 80 million. And he said, beta, that just doesn't make any sense to him. And I kind of agree.
Nathan, what do you think about beta?
So beta is one of those measures that I think it's really important to be clear on what you're trying to do with that measure and really where that measure comes from. And, the background on beta is it comes from the capital asset pricing model, which is a wonderful theory and makes a lot of sense. And theory basically goes, if you want to figure out what kind of return you should get on an investment, you start with the risk-free rate and then you add to it some premium for investing in something that's riskier than a treasury bond. So if you have a stock, there should be some premium over treasuries to invest in a stock. And then if a given stock is riskier than the rest of the market, you should get an even higher return. And so I think pretty much everyone would agree with that logic that, higher risk should mean higher reward. It's the beta is the way that they measure the firm-specific risk. And so I think measuring firm-specific risk is very important. But beta, I'm not sure really does that, to Chuck's point. Beta looks back at how the stock price has correlated with the market, but that's not necessarily the same as what most of us would think about risk, which is like, what's the chance that something bad's going to happen? And that's much more related to the fundamentals of the business and maybe the trends in the industry or for the firm, and not so much related to just how correlations have looked. And also, beta is not the most stable measure, and that it depends over what time horizon it's measured over and the frequency of the data that you use. So, theoretically, I like the idea of beta, but the actual measured betas, I think we have to be a little bit careful about how we interpret those and don't lose sight of what I would call more like fundamental risk as opposed to, price correlations with the market.
Thanks, Nathan. And Bill, what about you? What is your opinion on beta?
Well, to me, it's just another metric. And just to understand it, the market should be at 1, the total market. If beta is higher than 1, then volatility, as Nathan and Chuck said, should be more. If you've got a stock with a beta 2, it's probably going to go up higher than the market if the market goes up. It'll go down more than the market goes down. If it's a low beta, below 1, it will not go up and down as much as the market. So it's just something else to look at and think about. It's another metric, but I agree with Nathan and Chuck.
So something to look at, something that you should look at really and understand what you're looking at, and depending on what it is, not put full, credence into it, but at least something else to look at. Okay, thanks guys. So next question we have then is, what is the long term? What is considered the definition? And then what do you guys consider being the actual definition of long term? Bill, why don't we start with you on that?
Well, in accounting, we talk about current assets, current liabilities, and that's in the next 12 months. Long term is anything over 12 months or over a year. Now, in my own mind, in my own investing philosophy, long term could be forever. If I'm going to invest in a company and a great company, I can't see any reason to ever sell it. If it's giving me dividends and it's going up over time and it's a great company growing sales, profits, and cash flow, I'd stick with it forever. So long-term varies, but usually over a year is what we consider long-term.
Okay. And Chuck, I know you talk a lot about the business cycles being long-term. So roughly how long is a business cycle, and why is that important, and why are you deeming that as being long-term?
Yeah, thanks, Cole. The reality of it is, I call value investing as analogous to business perspective investing. You're investing in the business as a shareholder, partner, owner of the business. You're not, quote unquote, playing the market. You're not looking at the market as a big casino where you're placing bets and trying to cover those bets in short periods of time. Businesses take time to create value for their shareholders. A friend of mine joked once years ago. He said, companies report either quarterly or 4 times a year, whichever comes first. And the reality of it is, everything in between that is really a lot of noise. You're not really getting hard, solid information until you look at a quarter to the next. And it takes companies time to grow. It takes time for them to grow their business. So 3 to 5 years is a minimum business cycle to me. But I also agree with Bill. Warren Buffett said, the best holding period is forever. And when I'm going to buy a stock, that's how I approach it. I'm thinking about, this is a business that I want to partner with for the rest of my life, so to speak. I want to be a full-time, long-term partner in that business. So if you're thinking about stock price action, and emotions determine market price in the short run, and they're very hard to quantify those, and they're also ethereal. They change with the wind. Fundamentals tend to be more long-term oriented. If a business is growing at 10%, keep in mind it takes over 7 years for that company to double its revenues, earnings, and cash flows at that rate. So, you have to give it time. So, from an accounting point of view, I agree with Bill. From a tax point of view, long-term gains versus short-term gains. But from an investment perspective, the long haul is measured in years, not months or days, in my opinion.
Okay, thanks. And Nathan, what about you?
Yeah, I think my simplest definition of long-term is kind of my investing life for that particular type of asset. As long as I intend to have exposure to a certain type of asset, that's how long I would look at. And most of the time that's going to be, years, multiple years. And yeah, I think it's just, a lot of the principles of investing, as Chuck said, take time to show up sometimes. So if you look at correlations between prices and fundamentals, short term, those lines don't always match up, but over the long run, they converge. And so for the reality of fundamentals to really be reflected in price is not always immediate. So, trying to have a specific time frame where you need that to happen, I think sets you up to miss out on opportunities and not realize the full benefit from gains and cash generation and other fundamentals.
I think this brings up good questions about, a lot of people always have the question of, then when should I buy and when should I sell? And all of that, to my understanding, will be covered in Value U Academy. And the three of the professors here will help everybody learn and make better decisions and understandings of when to buy and sell. But that's kind of a topic we can't go over now. But one thing that we can go over now that a lot of people have questions on is diversification. So how many stocks should you own in a portfolio, and why? So Chuck, why don't we start with you on that question?
Well, thanks, Cole. Diversification is, one of the more commonly asked questions out there as well. And it's also one of the most commonly debated questions. I've seen studies recently that talk about things like, once you get past 16 stocks, you've basically used up all the benefit that diversification would provide. You've got people like Charlie Munger and even Warren Buffett and many others, by the way, many of the great fundamental investors that I've studied talk about the importance of concentration. You want to have a large enough number of stocks to protect you. You don't want any one stock to be too dominant in your portfolio. But at the other hand, you want to have a small enough number of stocks so that if you have a meaningful return, from one individual stock, it actually gives you meaningful results in your portfolio. But I think finally, the fewer stocks you own, the more you can know about them, and knowledge is clearly power. And so, if you start getting too many stocks, you can suffer from what I believe it was Peter Lynch said in his book, One Up on Wall Street. He called it diversification. Of course, I think Peter had like 2,700 stocks in his Fidelity fund, so he wasn't really one to speak. But the point is, you want to have enough diversification to protect you. And I'm talking about a stock portfolio here. But the other hand, you want to have a small enough number of, I believe in a concentrated portfolio so that I can know something about each stock. But then you get into the other areas of diversification, what percentage should be in equity, what percentage in bonds. And those are entirely different questions altogether.
Okay. Are those questions that the curriculum will go into? Do you know off the top of your head?
Yeah, I think we'll be covering that and more. It's going to be a very comprehensive curriculum we've got planned.
Awesome. Sweet. So Nathan, let's kick the same question to you in terms of diversification. What's your opinion on it? How many stocks should you own?
So, diversification is a risk management strategy. And I think the don't put all your eggs in one basket adage makes a lot of sense. But a kind of counter to that is maybe you do put all your eggs in one basket and you really guard that basket, right? So to Chuck's point, if you don't spread yourself too thin, sometimes it's easier to manage risk through information and research and really understanding what you're doing. And, Buffett talks about diversifying prudently. And I think that makes a lot of sense, which means basically don't diversify for the sake of diversification. You don't want to take a bad investment just because it gives you exposure to an industry that you don't currently have in your portfolio. You want to be sensible and prudent and make sure that you have a process that you follow that isn't based entirely on the goal of diversification. That said, of course, you definitely want to have some diversification, and I think it makes sense to have some spread. And exactly where you draw that line, I think, depends on, one, what you're comfortable with, and two, really what opportunities are available. There might be times where the opportunity to move into certain industries just isn't prudent because the valuation doesn't make sense. And so it's a little bit time specific and individual specific, but that's how I approach the topic generally.
Okay, awesome. And Bill, what about you? What's your opinion on diversification?
Well, once again, I agree with both Nathan and Chuck. And, just from a personal standpoint, diversification, I like to have some real liquid assets. So I'll keep some money in short-term bond funds, maybe, that's very liquid. I just want to keep up with inflation. But most of my portfolio, I want to diversify in different stocks, different industries. Might want to have some real estate, some other things. I just think spreading it around, like Nathan said, you don't want to put all those eggs in one basket. And it's been proven diversification is a good thing if you don't get carried away and do too much of it.
Right. Yeah. I thought those were good points. I always thought of diversification over diversifying in terms of, your money's not going to work as much as it would being less diversified, because if you have a 10 bagger and only 1% of your portfolio is in that, then it's not really going to return much. Whereas if 4% of it is in that 10 bagger, it's going to return more. But Nathan brought up a good point about, being able to keep up with the information and the research. That's also another good reason to not over diversify. But going back to the weighting that I was talking about, 4% versus 1%, another really important question is, should you equal weight or overweight your portfolio? How do you normally manage it, and why would you overweight and underweight certain things if you do? Nathan, why don't we kick that off with you?
So I think one of the keys to prudent investment process is really making sure that you're clear on your rationale and your assumptions and your kind of approach to things. And with that said, equal weighting, if you equal weight your portfolio, you're saying you are equally confident in all of the stocks you've invested in, right? And if you don't equal weight, you're saying you're more confident in the stocks that you've overweighted and you're less confident in the stocks that you've underweighted. And I think there are times where either of those could make sense. But I think I would like to start with, what does it really say if I'm going to equal weight versus if I'm going to overweight? If you feel like you have one opportunity that's better than all the other stocks in your portfolio, it probably makes sense to overweight that opportunity. If you feel like I like all the stocks in my portfolio relatively the same, then I think equal weighting makes a lot of sense. And so, I don't think there's necessarily one best way to approach the weighting idea, but just kind of making sure that it fits into your process and at least it matches the story you have and the analysis that you have about the stocks.
Okay. And I want to throw out an additional question in terms of weighting that I want everybody to think about. And Nathan, maybe we could circle back to you once we hear from Bill and Chuck. But going off of being more, liking a stock more and expecting more from a stock and overweighting it, is there a reason to overweight more undervalued stocks in your portfolio versus, stocks that are more in value and stocks that are overvalued? Or would you be even weighting overvalued stocks as bringing them down to an equal weighting and just trimming them when necessary? Bill, why don't we start with you and then we'll finish with Chuck. And like I said, we can circle back with you, Nathan, to close off that question.
Yes, Colton. And I think you've hit on a good point because, yes, I've seen stocks that I've invested in go straight up, and it's wonderful, but they do get overvalued. And then you think, oh, I've got so much in this company. It's made me a lot of money, but it's very much overvalued. We can look at that and look at the fundamentals and so forth against the market. And it might be time to take a little off the table. So I do keep my eye on my investments, and especially if something goes straight up, you might want to take some money, put it in something else, at least part of it. That's kind of my philosophy.
And when you're taking money, I mean, I guess this is each scenario is different, but in general, when you're taking money off the table on something that has shot straight up, are you bringing it generally to a equal weighted position or a underweighted position? Or is it just, that's a hard question to answer. Is that something that is really just a case by case?
Yeah, myself, I'll take that money off and then I'll say, well, there's other companies that are not overvalued and I'm going to put it there. And I might look at their dividend yield, I'll look at their future, look at their credit rating and other metrics and just kind of spread it out. And once again, look at the percentage. I do keep track of percentages of my total portfolio by investments. If I see something that has a very high percentage, then I analyze that, or if something's a very low percentage, I might want to get rid of it if it's not good. So yeah, those are important things to think about.
Okay, thanks. Chuck, what about you?
Well, I'm going to, kind of bring back to the first point I think that Nathan made. This is all about controlling risk to a great level. And Bill actually shared with me an article that was written, I think it was in Barron's Bill or Wall Street Journal. I don't remember. And I remember the article where it talked about the great economist John Maynard Keynes' 6 investing principles. And of course, one of those 6 principles is the margin of safety concept. And that to me is the foundation of value investing, And so, I will have a tendency to want to weight a stock that's undervalued a lot more than I would one that is fully valued. Personally, I would never, invest in a stock that I thought was overvalued or even too fully valued for that matter, because I'm, a fervent believer in this margin of safety principle that is so critical because it reduces risk, but it also simultaneously enhances rates of return. But this whole idea about weighting is something that's very interesting as well. You can be very creative with how you weight a portfolio. For example, I did manage a portfolio for a client years ago who was real concerned about risk at the same time, but he was also aggressive. He almost had a schizophrenic attitude about investing. And what we did was we put 50% of his money in 10 stocks that were all, and this is back in the kind of the birth of tech. This is going back into the mid 70s. We were buying names like Microsoft and Oracle, and then there was a company called EMC, and we really heavily weighted these 10 high growth risky stocks. And then we put the next half of his money in 50 additional stocks, almost more, analogous to an index, if you will. And, we didn't worry too much about those stocks because we had a small weighting to the point you made earlier, Colton, in each of those. But we focused to, I think, Nathan's point about putting, your money in fewer baskets and watching those baskets very closely, because we tried to know as much as we could about that. So you can be very creative about that. But a lot of it comes down to just your individual, risk tolerances, goals, objectives, and needs. But I think it's also important, and Nathan, I think, made this point, in what's going on in the market. If you're in a, highly inflated market environment like we are today, it's very hard to even find value to, so I have a tendency to want to own fewer stocks today with bigger weightings, simply because they're hard to find stocks with good values. In a bear market, like the bottom of, in, let's say, January, February of 2008, it was a value investor's dream. I mean, I wanted to put 100% of my money in every stock I looked at almost. It was crazy out there. So, these kind of questions are all relative to a lot of factors: the level of the market, the valuations of the stocks, your attitudes, how much money you have, et cetera. But, you can be creative with that. There is no one size fits all. I think that's the important message there.
Okay, thanks, Chuck. And Nathan, with the additional question of weighting that we added on, I just wanted to let you answer if you wanted to circle back at all.
Yeah, sure. So I think, like to follow up on that question and what Chuck just said, I think there's one of the goals of Value U is to really help individuals link what their objectives are to an investment process. And so I think it's really kind of this matchup of, if like the example Chuck gave of this investor that wanted to be aggressive in parts, you can really think creatively and adjust this, but you also want to be very clear on what it is you're doing when you make these weights. And so just for instance, if you only have like 2 stocks in your portfolio and you're equal weighted to start, and one of those stocks doubles and the other stock doesn't do anything, you now have 2/3 of your portfolio in the stock that doubled and 1/3 in the other stock. And then so the weights have changed without you doing anything. And so the question becomes, do you want that? And that would depend on whether the stock that doubled still looked really attractive, right? Or whether it now looked overvalued. It would be specific to the context and to your goals, but you just want to be aware of that and realize that change should happen, and realize that your weighting implies something about your confidence and your expectations, and make sure that matches really your analysis and the value of the stocks that you hold.
Okay, awesome. Keeping on the concept of confidence and where you think the stock is going to go and how you tend to overweight things you're more confident in, we can only invest in the future. We can't invest in the past. That's a reality. Chuck, designing fast graphs, it has a ton of historical views, and I want you to kind of expand on that. But the main question is using analysts' forecasts. What are you worried about accuracy, and what has fast graphs created to worry about analysts' accuracy for 1 year and 2 years out versus their estimates that they're changing every single day?
Yeah, thanks. Well, that's a really important question. The idea that, I believe, first of all, it all starts with the notion that you already said, you can only invest in the future, not the past. You can learn a great deal from the past, and you can learn a great deal about the type of company you're investing in by examining its past record. You can also check on things like, is its growth increasing or decreasing or staying the same? Is the business deteriorating, et cetera? So there's a lot to be learned from the past, but ultimately you must invest in the future. So forecasting to me is the key to long-term success, but it's also mandatory. Unfortunately, the only thing that we can say with any certainty about the future is that it's uncertain. We can't really know. So the idea of looking to leading analysts that are theoretically following these companies and analyzing them and, meeting with management and attending investor days to look at their forecasts, as a starting point, I think just makes common sense. Now, we developed in fast graphs, to your point, the Analyst Scorecard. Another thing that people don't, often consider when they're looking at analyst estimates, analysts are constantly updating their estimates. And typically when you see these reports, for example, when the company reports their earnings, they beat it by a penny or missed it by 2 cents. That's usually based on the last estimate that the analyst gave, which might only be a month ago or a week ago. Okay, so what we did was we went and we created an analyst scorecard that measured what the analysts were saying about a future estimate precisely 1 year prior to that actual happening. And then with a 10% margin of error, because obviously you got to be naive. You can't expect these analysts to be perfect. No one can. And then with the 2-year forecast, the longer out you go, the more difficult. We give a 20% margin of error, but we measured how accurate the analysts were when they were making the estimate, for example, for 2000 and 1998, precisely 2 years prior to the company coming out. And then we measured that. But this is perhaps the most important thing. It's not about how accurate analysts are generally. It's about how accurate they are specifically. So what we do with our scorecard is we measure how, accurate the analysts have been forecasting a specific company. And the reason that's important, you take a stock like U.S. Steel, for example, that's very cyclical, has a very erratic record. Ford Motor Company would be another one. Analysts often get the estimates wrong. This company is just very difficult to analyze. And by the way, guidance is also a factor here. Most of these analyst estimates come from company guidance. And, some companies give good guidance, some companies don't. Some companies are just playing with the same dilemma that we are. They have a lot of trouble trying to give good guidance, trying to forecast their futures perfectly. So you've got to measure that on a case-by-case basis. But to generally say analyst forecasts are good or analyst forecasts are bad, in my view, is nonsense. It's just another, prejudiced viewpoint. You've got to look at it on a case-by-case, company-by-company. Bill talks about Johnson & Johnson all the time. It's got 100% perfect analyst scorecard because it's just a very, predictable, AAA rated, easy company to forecast. So when I'm looking at forecasts for J&J, I give it a lot of credibility. If I'm looking for a very, cyclical stock where the analysts are missing estimates, let's say more than half the time, I don't put a lot of credence in their forecasts.
I think that goes back to your saying, Chuck, about it's a market of stocks and not a stock market. So Nathan, why don't we kick that same question off to you? So analyst forecast and worrying about accuracy, just kind of expanding on what Chuck said too.
Yeah, it's one of my favorite features on fast graphs because I think, the whole premise of what's going to drive stock price and value in the long run is cash flow generation, earnings generation. And so you want to have some idea of what that's going to look like when you make a decision. And analysts are a great place to start to do that. But the question is, how much can you rely on those projections? And the Analyst Scorecard gives you a really quick way to say for a given stock how good of a job they do. And then, the follow-up is, what does that tell you? Well, Chuck gave the example of J&J being very accurate. To me, if the analysts are really accurate, that's another way of saying there's less risk, in terms of there's less risk with respect to the fundamental, right? You still have to compare that to price, but as far as like what's going to happen to growth of cash flow, what's going to happen to growth of earnings, you have relatively less risk. If the analysts are all over the place or they're missing by, big numbers, then you have more risk. That doesn't mean that, you rule out that company, but it means you have a wider range of possible price paths for that company. And that is really informative. I mean, to me, that's really powerful information to have. And it also tells me I'm probably going to need to come up with my own story about growth and my own idea about where earnings are headed. Whereas if the analysts are doing a great job, there's no need to reinvent the wheel and do a ton of analysis on that. You can probably pretty much go by the analysts. So, I really like having that feature, seeing how well they've done in the past. And it also tells you how many analysts are following, which to me is important because, if there's only a few analysts, those numbers can get kind of skewed by just one kind of outlier. Whereas these companies like J&J that have a lot more analysts, that average number to me is a little bit more meaningful in many cases.
Yeah, I think you bring up some good points there, that the number of analysts, the higher it is and the more accurate they are, technically the less work you have to do in terms of forecasting. Definitely not saying don't do any work and you should make your own decision, but it definitely helps reduce the workload and decrease the time it takes for you to research a stock, which is what Chuck set out to do with fast graphs anyways. Bill, I wanted to open the same question to you about using analyst forecasts and worrying about their accuracy, and see what comments you have on that.
Well, I would just agree with what's been said in that you're always thinking about the future. Where's something going in the future? And analysts, they spend all of their time looking at a company, knowing a company, and I definitely want to hear what they're saying, look at what they're saying, and looking at those dotted lines going into the future in fast graphs has always been very important to me. You can look at the company's bottom line, their return, divided by the number of outstanding shares. That earnings per share is such an important metric, and we're always trying to guess that into the future. And that comes from sales. And as Nathan said, also cash flow is even more important. So yeah, I want to look at the analyst guesses, and I want to watch them. And if they look good, that's always a positive thing on a company.
Okay, awesome.
Yeah, so let me add two things to what's been said. Number one is analyst forecast should not replace, your own comprehensive research and due diligence. And again, I think you can do, more work if you've got unpredictable analysts, less, as Nathan pointed out. But the other thing is FastGraph also has a feature where we show what the estimate was 6 months ago, 3 months ago, and then the most recent estimate. So you also get a feeling whether the estimates are improving or whether the analysts are getting, more pessimistic about the company. So, it's a tool just like all the other tools. And the forecasting calculators are called calculators, just like any other calculator. It's garbage in, garbage out, input in, input out. So you're always, you have to use them prudently, in other words.
And I'm sure the Value U Academy will really show some use cases of utilizing those forecasting calculators, and people can already refer to the YouTube channel anyways. I know you go into depth of using those forecasting calculators quite a bit, Chuck. Okay, so shifting gears to the last couple questions. One thing that people are always worried about, Chuck, you brought it up earlier in the diversification question about bonds. Sometimes, it's not just diversifying the equity, but it's also diversifying the asset classes in your portfolio. So what about bonds? What roles do they play? I want to ask the questions in two parts. Let's ask it in the sense of, in today's time, it is 2021, early 2021 with super low interest rates. So I want to hear what you guys have to say about bonds in the current world, and then what bonds play in more of a normal interest rate world and what they can do for your portfolio. So Bill, why don't we start that question with you?
Sure. And, there's been a lot of theories about what percentage of a portfolio should be in bonds, and looking at a person's age, and as you get older, a higher percentage and less in equities. But in today's world, that inverse relationship of interest rates to prices of bonds is so important. And I think we can all look at today with what's gone on after this pandemic. And everybody's talking about the possibility of inflation picking up its ugly head and interest rates going up. And, bonds have been a great investment in the past, but will they be in the future? I think we have to really keep our eye on that. And my thought is that equities might be the place to go in the future as interest rates go up. So, these are things you have to analyze and continue to think about. Interest rates have a lot to do with bonds and returns.
Okay, thanks. And Nathan, what about you?
I think this kind of fits in with matching whatever an individual's goals are. And you just want to be clear of what you're getting with bonds and what you're not getting with bonds. But, bonds are more of an income play, which is certainly interesting to a lot of folks. It's not the only income play, right? You can make other plays even in equities with dividend payers to get that. But, I always think about, when I think about non-stock comparisons, I'm still kind of comparing it to stocks because it's still really you think about, here's all the opportunities you have to invest and which opportunities gives you the right return for the right amount of risk that you want. And, the answer of whether or not to be more or less in bonds or stocks, I think depends on the time in which you're looking at that. If the reward to risk, the expected reward to risk that you have makes sense in one asset class a little bit more than another, then you probably want to skew a little bit that direction. So I think it's a dynamic thing to watch, and it really just depends on the time. But certainly I think bonds can have a good place to play in a portfolio, but you would just want to be clear what you're getting yourself into there.
So it's definitely, like everything in investing, it's multifaceted. It's not just one answer. So risk comes into play largely with it. But I think another point to talk about, and Chuck, I know you mentioned earlier, not in this call, but when we were chatting earlier, about a client that you had. So portfolio size also maybe comes into play, because if you're getting a 3% return on yield on a $50 million portfolio, that's generating a lot more money at safety than if you only have a $20,000 portfolio. And maybe for lower portfolios, you automatically need to assume more risk because your money's not going to be working for you. But obviously, if you're older in age and it doesn't fit your risk profile, you shouldn't just be going as aggressive as possible. But Chuck, I want you to comment on all of that and maybe even tell the story of that client that you brought up earlier.
Yeah. And, when it comes to bonds, I'm not for them or against them. Any investment at any time has to make sense in the context and the environment that it's offering in. When interest rates are very, very high, I can remember back in, I guess it was the early 80s, someone might help me with my history, you could get 14, 15, 16% on a treasury bond. Made absolutely no sense to buy a stock. You had this, twice the market normal average rate of return from AAA rated bonds. I mean, it was incredible. Today, as you pointed out, 2021, you've got virtually zero, interest on bonds. And I think people forget that bonds can be just as volatile as stocks. The idea that bonds are stable is only partially true. The shorter the bond is, the more stable it tends to be as it gets closer to maturity. But you start buying 30-year, 50-year, and even 100-year bonds that have been, popular years ago. You got to hold those bonds for a long time. If interest rates, go up from the time that your bond was issued, the value of your bond is going to go down because people can buy new bonds and get higher yield than they can on your bond. Therefore, they're going to pay you less to buy your bond, so they get the equivalent yield. So it really depends on the environment, the situation, et cetera. And to me, traditionally, I don't like this, 60-40 rule where you put 60% in equity, just arbitrarily saying and 40%, in bonds or vice versa. To me, you have to adapt to what the environment at the time is saying. Most of my career, I invested in bonds. I haven't bought a bond in 20 years, and it's really because interest rates have been going steadily down. But having said that, the bonds that were bought 20 years ago have done extremely well. You could have actually sold them at a premium almost every time that you held them. But to what Bill's point made, if you buy long bonds today, the odds are their value is going to be a lot less 5 years from now if interest rates do rise than what you paid for them. So, you want to be practical and pragmatic about these things. I always use bonds because they typically, in the normal world, as you pointed out, Colt, generated more income than you could traditionally get from a stock. Now, stocks had growth yield. Some people, most people call it yield on cost, as I think Nathan alluded to. Your dividend increase, can eventually catch up to bonds over a longer period of time. But in the immediate future, bonds would pay 6 or 8% in normal markets. Stocks would pay 1 or 2%, and it always made sense if you needed income to get the income from the bonds and mix it. And you also always had the option of how you manage the bond portfolio. Laddering was always the key. You would put so many bonds in, a certain percentage of your portfolio in 1-year bonds, 5-year bonds, 10-year bonds, 15-year bonds. You could adjust those ladders all different ways. And then when one segment of your ladder matured, then you had the option of looking at interest rates and saying, okay, interest rates are really high now. I'm going to buy long bonds with my matured money. Or if you're in a real low environment like we're now, you could say, well, the bonds that I've matured, I'm going to keep them short term because there's too much risk going long. So it's like any other investment. You've got to be practical, pragmatic, and you've got to think about the investment from the standpoint of, what it's capable. Just don't say bonds, everybody should own bonds. That's true only if the bonds make economic sense at the time you're buying them.
Okay, thanks. And I wanted to just end this with one last question, and that's based off of investment goals and objectives. We've brought that up quite a bit this call, but we haven't really jumped into it. And I kind of want to talk more about inputting bonds into your portfolio. Chuck, you mentioned that you don't like the 60-40 rule. So with goals and objectives, for everybody has different goals and objectives for their investment portfolio. That should mean that maybe they could do a 60-40, or maybe it needs to be a 90-10 and 90-10 equity, 90-10 bond, or vice versa, depending on what their goals are. And the other thing is everybody's always worried about beating the benchmark, and they tend to use the S&P 500 as a benchmark. So is the S&P 500 a good benchmark for everybody, or are there different benchmarks that people should be worried about beating? Chuck, why don't we start with you?
Yeah, I think really it boils down to there's different reasons to invest. You mentioned the story, and I didn't tell it. A CPA that we did business with who had a client that had $50 million in treasury bonds. And this CPA's name was Chuck, incidentally, and Chuck used to keep trying to convince this gentleman to put some money in stocks. And the man said, I spend about 10% of my income from the bonds. I reinvest 90%. I don't have any interest in making any more money than I currently have. I don't need it. I don't want it. I've got plenty for my family. He had no reason to ever own a common stock. Vice versa, you mentioned somebody that's got, say $20,000 or $30,000. You can't live off of the income that can produce, whether it's from a bond or a stock. So you better build up that portfolio over time and figure out a way to double it and triple it and quadruple it and, grow it over the years. So all these things are relevant, so, you don't always want to invest just to quote unquote do better than the market. And one point that I want to point out today, you've got a massively inflated S&P 500, to use that benchmark you mentioned, Colt. I don't think trying to beat that makes sense, because I believe that benchmark is already too risky, number one. And the only way to really beat it is to take even more risk than the benchmark itself has. So you might want to be more prudent, at that point. And also, if you need income, you want to invest for income. If you need growth, you want to invest for growth. So, people invest for different reasons. I think that's the key point. And it's not always about, can I only, am I trying to beat the S&P? Am I trying to reach a goal? One thing I like about dividend paying stocks, it should be mentioned, dividends are the most predictable aspect of common stock investing. They're not 100% predictable, but you can count on your dividends, coming in every quarter and every year. And if you buy things like Aristocrats that Bill talked about earlier, you can pretty much count on them raising your income every year as well. Where the stock price, who knows where it's going to go. We've seen, with COVID and everything else, we've seen some really wild examples. We'll be covering a lot of that in Value U Academy. So it's really about, what are you investing for? What are your needs? What are your goals? What are your objectives? What are your risk tolerances?
Okay, thanks, Chuck. Bill, what about you?
So true. Just agree with everything Chuck just said. Absolutely. And, it depends on your stage in life. There's so many things. If you're a young family just starting out, you want to get rid of your debt first, your high interest debt. And then if you save some money, you want to put it in something maybe for your kids' college education in the future. So we all have different goals and objectives. At my stage in life, I want to preserve my principal. I don't want to see my principal disappear. And if I have additional income coming in to supplement, my Social Security or other things, that's wonderful. So it's all about our own personal goals and objectives, and learning what to do, when to do it.
Awesome. And finally, Nathan, what about you?
Yeah, I think for me, the goal and objective that sits on top of all the individual ones is you want to get the right reward for the amount of risk that you're taking. So a lot of great points both Chuck and Bill made is what the reward you want might differ based on your age and situation. The amount of risk you're willing to take might vary, but being realistic, if you have a very low risk tolerance about the kind of reward you can get, or if you need a certain amount of reward, making sure that the amount of risk you're taking is really prudent. And so there's different ways to approach that, but I just, I want to make sure I'm getting a fair deal as an investor on the risk reward front, and that I'm meeting my objectives, that I'm getting there. And I just think having some sense of what's even possible is a good place to start. It's one thing to say, I need this return, but that doesn't mean that return necessarily exists or is going to easily exist. And so just having some sense of what can really be accomplished with different assets and different stocks. And I think, it's kind of a slippery slope if you start getting into I have to get this return. And so you start hoping for a certain outcome instead of this is what the numbers look like is reasonable. This is what the past tells us is possible, that sort of thing. So that's kind of how I approach the goals and objectives. And, the good thing about learning the investment process through Value U and having something like Fast Graphs is you get to be a lot more in control over making those goals a reality by making decisions.
Yeah. And I think that's a good point when you're dealing with investing, and you need to treat it and pick reasonable and obtainable goals and objectives. I mean, you can't just have a $20,000 portfolio and expect to get $100,000 in income per year. That's just not obtainable or reasonable. But, those are things we could talk about for hours and hours to come. And there's going to be hours of material in that for Value U Academy. I think that's everything that we have today. So I wanted to thank you guys for the call again today. I want to remind everybody to like, comment, subscribe, and don't forget to share these videos as well. It helps us really grow the YouTube channel, and just keep an eye out for Value U Academy that will be starting to release over time and in the near future. Before we part, Chuck, I just wanted to see if you had any closing words for Value U Academy and for the subscribers.
No, I mean, other than to say that, we're all as a team here very excited about the opportunity to educate people, to empower people to make more prudent, sound long-term investing decisions, and simultaneously provide the tools to do that. So it's going to be a lot of fun. We're going to try to, have it be interesting as well as educational. And we're going to be covering an awful lot of ground. We're going to be getting deep into analyzing financial statements. We're going to get deep into how to value a stock. We're going to get deep into just generally sound investing principles along. So, it's going to be a fun journey. And we really all are, as a team, I know, looking forward to it.
Awesome. Well, once again, thanks, guys.
Thank you.
Thanks. Bye-bye.